Welcome to Investing by the Books, a podcast by Redeye. I'm your host Eddie Palmgren, and with me in the studio is my colleague Niklas Sävås. How are you today, Niklas?
I'm all good, thank you.
Same here, and in this episode we are excited to introduce a new format where we invite fund managers and other prominent guests to share insights from their favorite investing-related books. And the idea is that those of you who have not read the book will get inspiration and understand what it's about. And for those who have read the book, we put the content in context to see how it can be applied. So, Niklas, who is the first guest of this format?
Our first guest is the brilliant Henrik Andersson, who is managing the global equity fund at Didner Gerge in Stockholm, and is also a founding member of Investing by the Books. Henrik did the interview with William Green, which is our fourth episode of this podcast. Welcome to the studio, Henrik.
So, Henrik, how did your passion for investing start?
Well, it slowly developed over time. Let's put it that way. It was the second kind of a passion, where the first one, I guess, is where you're struck by lightning, and the second one is slowly developed and nurtured over time. Then, and my time with investing, or my interest, started when I actually gained a tennis scholarship to a university in the U.S., University of Nebraska, and that's obviously a place where a very famous investor is born and active. So we were inspired, especially my professors at the school were inspired by his teaching and his investing, and that obviously sort of fell down on us students at the school. So that's where it all started, and has grown since then, and this was in the mid-90s then.
And which book have you chosen for this episode?
I have chosen the book where the person in mind, then, Warren Buffett, where his teachings and perhaps his lessons about how to think as an investor is the most clearly articulated, which is Essays of Warren Buffett by Lawrence Cunningham.
And the essays are written by Buffett, but the author of the book is, as you say, Lawrence Cunningham. What's his role?
Yeah, good question. It's I think it's pertinent that we bring it up. So the story of the book is actually, it was originally a seminar or symposium at Cardozo Law School, which is the university where Mr. Cunningham was active at the time. So in the fall of '97, they arranged a symposium where law professors and Mr. Cunningham and Buffett and Charlie Munger also took part, and they discussed the paper that was written in the Cardozo Law Review, which dealt with corporate governance and how to look upon board membership, how to run a board, how a company should be organized, but also what's investing and what's more speculation, actually. So it was interesting that it was the legal angle that first started this project, and then post the symposium, which it's actually to try to find pictures, because I know I've seen pictures from that particular event, which was actually great, but I didn't find them now before this podcast. But post, they had this day at Cardozo Law School. Cunningham arranged the discussion and the chapters and the conclusions, and sort of organized it into a book that was published in '97 and again in 2001, with 7 different topics or chapters, which he then chose from Buffett's writing and his CO letters. And I actually have to say that the introduction by Mr. Cunningham to the book that's a great part. That chapter in of itself is one of the best parts of the book, and he shows a deep understanding for Berkshire and for Buffett's thinking, which I think is somewhat unappreciated, perhaps, in the later years now. And it's not. The final thought I have is it's not that easy, it seems like, well, he just chose some words that Buffett have and put it together, but it's not easy to make it into a comprehensive story and a well-written book. It's, imagine trying to find 100 clips of Leo Messi goals and then make it into a full movie with a storyline and a comprehensive teaching. Not easy, but Mr. Cunningham pulled it off, and I think the book is one of the great all-time investment books.
Yeah, I agree fully. And me and Eddie have later editions of the book. I think there have been 5, and I think it will be updated until, as long Buffett lives. I wanted to ask you why did you choose this book? Is this how do you rank this with other investing books?
For me, it's top 5 of all time, I would say. We also at Investing by the Books we've discussed and have done previous rankings of all time great investment books and so forth, and even organized it a bit by classics and modern books and so forth. And I think it's always been in the top 10 of those rankings, I believe. So for me, it's a must read. It's a great book to not start your investment journey with, but after a few years perhaps, and then as a biannual or a sequential read over time.
Yeah, I think the praise from Money Magazine that is on the cover of my edition at least sums up this book perfectly. They write that it's extraordinary, full of wisdom, humor, and common sense. The book is structured around several pillars: governance, investing, alternatives, common stock, acquisitions, valuation, accounting, taxation, and others. But if all copies of this book were destroyed, but you could keep one chapter, which one would that be and why?
That's a good one. It's the opposite of what you're normally asked. What would you throw away if your house was on fire? But I have to say, I mean, I physically remember the first time I read this book, which was actually on an investment road trip in the U.S. where we in the summer of 2007, which is the first time I read it from cover to cover. And the part about investing that sort of struck me the most was when he talks about or the episodes from the CEO letters, so to speak, where he talks about the efficient market hypothesis and beta and risk and what's business and what's stock market risk. That discussion, because I think like I said before, this book is perfect for reading from time to time for seasoned investors, but I think the other group of people that should read it is the ones that have perhaps done investing for 5 years, 4 or 5 years, gotten introduced to it. They're in business school or have picked up books that talk about risk, the efficient market and so forth. And then you read this to get a totally different picture of what business investing means, because then the lessons of the book is so much stronger. And just the example he gives in the book where when he talks about beta, it just struck me because I've been introduced to that concept, and we try to, or my organization that I worked at the time obviously used it, and it was a big part of our risk analysis. But why would a stock that's gone down 50% in the business is not impacted be viewed as twice as risky, which is what beta says then, very simplistically. And that chapter, I think, is profound in its impact on somebody who's been introduced to EMH.
I guess beta has no idea about the quality of the company and the competitive advantages and so on.
So I was thinking there are many ways to emulate Buffett, his style of investing, but also, of course, his investment and business philosophy centered around rational thinking and patience. And I wanted to ask you, how has his lessons shaped your career as an investor?
Well, first of all, I think what comes out in the book, and obviously in lots of other writings and speeches and so forth from him, is that this book as with all great investment books, first you learn a lot. You underline, you mark, you sort of reread to emphasize certain things, but it also puts you in a frame of mind. You want to be a better investor. You want to be a better person, and this book really does that. And there are a few other investment books that do the same upon you as a person, as an investor. You don't do the lazy value investing where you look at a PE multiple, or don't do the lazy growth investing where you think somebody's grown 40% for 2 years, hence its growth. You want to do the fundamental work, and you want to appreciate people running businesses. So I think those two or three things is something that hopefully is very present in me, 20 years later.
And as you said in the beginning, Cunningham has truly done a great service to the investor community by compiling this into a book. But the alternative is to read the letters themselves. And how do you I mean, what's the main difference, would you say, between reading the letters themselves and the book?
So the book, I think, was the letters from 65 to 96 then, or something. And obviously since then he's written quite a bit more, and other books and other speeches and so forth have been produced.
Yeah, the later editions of the book, they include later writings.
But I would say that in its recommended, you go to the original source, you read all his letters, and you read the partnership letters and so forth. But if you want to start somewhere, 3, 4, 5 years into your investing career, start with the book and not with all the letters, because it's just the letters going into this book is 750 or 800 pages, I think, which is quite a task. And it's easy to say, it's tougher to do for a 23, 24-year-old. And the advantage with the book is the how he arranged the different topics. Sometimes the letters can be a little bit long and overemphasized to certain things, which doesn't make sense, and it's very focused on what's happening at the time or that specific year. I think this book is much better because it organizes his thoughts coherently around 7 different topics, which is the most important 7 topics, I would say, of his writing. So it gives you a greater summary and a stricter setup.
So yeah, I agree fully. And we had Jeff Graham here on the podcast, and he's of course an expert in corporate governance. And in preparation to that discussion, it was perfect to go into this book and read about corporate governance and see, I mean, really what the true expert thinks on the subject. And I think, yeah, you can do that on each pillar of the book, actually. So it's really helpful. I was thinking also that, I mean, the book, the subtitle of the book is actually lessons for investors and managers, at least in my edition. I think older editions have different.
Lessons for Corporate America.
Yeah. And I feel like many investors are trying to emulate Buffett, and maybe not as many businesses. And I'm a bit curious to know why. And as I know you're putting a lot of effort into searching for the great companies in your fund, I really can't think of anyone better to answer the question.
Well, puts a bit of a pressure on on a person, but again, I think it comes back to the we discussed earlier around wanting to be a better investor and never taking the shortcuts. So I try to take those aspects about Buffett's teaching and this part of the book with me, but then also perhaps not only finding the ones that are trying to copy Berkshire, which it hasn't been that many for sure. We have one holding in our fund, which is Markel, and that's, I guess, the company that comes the closest to actually trying to emulate greatness. there has been no other real attempts to do it. So that's one part. But then also it gets to the teachings of the book that comes out very clearly in another chapter, which is the decentralization model and the ability to trust the right persons if you emphasize that factor. And it's easy to say, well, people change in businesses. I want to invest in the products and the longer term, and the CEO won't last for 5 years. Yes, that's true on average, but when you find the companies who are not caught in that mode, who actually have CEOs that last for a decade, or people where it obviously makes a difference, then it really stands out from the page. And I think that there's one paper or analysis that went through, right, the most, the CEOs with the longest track of being CEO, the longevity of a company, have the greatest share performance as well. I mean, if you just have a cutoff point at 10 years, and then those companies is where you invest, you do better. Obviously, never as simple as that, but really trying to take those two concepts, decentralization and trying to find the great people. We emphasize that even more today than 20 years ago when I read the book, because as a young person, you want to have stats, you want to have numbers, you want to have facts. But people can also be facts.
And from reading the book, I thought, I mean, studying Berkshire feels like that's really perfection, but not many businesses have the same qualities as Berkshire. And then I'm not thinking about actually their style of investing, or as you mentioned, like similar companies as Markel, but more the structure and the philosophy. And I was thinking how to seek perfection but settle for less, as not many companies have the same characteristics.
I would actually get back to discussion in the book on that as well, where he talks about share options and so forth, where obviously that's a cost, and he goes through, if it's not a personnel cost, what is it, and if personnel cost is not a something that should be in the income statement, what should it be, and so forth. That part, and that's totally true. And at one stage in my career, I actually looked upon share options as a real, almost a red flag. But then, and it also talks about EBITDA as that's a lousy measure to look at profits. And I think the quote is, "What do companies expect? The tooth fairy to pay for capex or depreciation or something?" And that's also true. It's just that it's very hard to avoid investing in companies with share options and that talk about EBITDA. And he does it himself, right? He never convinced the board of Coke or Gillette or Apple to get rid of stock options, right? And to speak about EBITDA. So in that sense, you want to have, again, you want to have a state of mind when you approach something to try to find it. But if you reach for the stars, you can go for the clouds, right? And I think that's what we try to find, and perhaps weigh the words and the teachings with the reality, and what he also does in reality.
So something related to that is mistakes of omission, and that is something that is included in the book. And Munger wrote for the 50th anniversary of Berkshire that almost all huge errors were in not making a purchase, and that had like at 2014 when he wrote that, it had cost Berkshire Hathaway's about $50 billion US. What are your thoughts on that? Like, it's also the search of perfection, but also, if do you have like a systemic approach to that?
Not really. I wish I could say we do, but I think that realization almost also goes back to the discussion of what kind of companies a fund should go for. And if you start with a blank sheet of paper, how do you set up a mutual fund or your own account where you try to invest in 10 or 15 names? And it's the realization that only 4 or 5%, whatever it was, actually produces 100% of the results of alpha versus the S&P. I think it was the best in study a few years ago, and that went into a lot more details, of course, and there's been post studies and post studies. But as a generalization, it's very few companies that provide all the alpha, and just realizing that and trying to find them and hold on to them. That's the sort of search for perfection, or realizing that omissions is the worst thing you can do. And again, our biggest losses have been the companies we didn't buy that obviously could be the 4 or 5%, rather than the ones we held on to and cut short, that weren't going to be the 4% of names. So that, I think, is the first or second question we ask when we look at a company. Can this company be a 4% one or not? And that's just trying to avoid some of the sins of omission, but obviously it's extremely hard.
Yeah, and you said one part is the managers and the people, and Buffett also writes that managing Berkshire is primarily a job of capital allocation coupled with the selection of and retention of outstanding managers. And you touched upon it a bit, but what kind of qualities are you looking for?
It's I think, first of all, people you admire yourself, because it brings you or gives you the ability to hold on for a long time. And you and I can admire different kind of people or different personalities. What I'm attracted to might not be the things you're attracted to, and it doesn't have to be that I like honest people and you like dishonest people, or aggressive people. It can just be that how they reason and their actions in the past. So trying to find people that resonate with you. And obviously I was marinated in the Buffett and Munger glaze, whatever, 20, 25 years ago. So I've tried to find people that remind me of them. Simple, down to earth, good with words, easy to articulate, trust people, and so forth. And obviously Tom Gaynor at Markel is one person that very much reminds me of that sort of personality. Also, Bruce Flatt at Brookfield is another example that sort of it's in the same tree of personalities.
Yeah, I recognize that as well, and I have experienced when you see a manager that you really, yeah, this is a person that resonates very well with me and it feels very good. But then what I found out later was that, well, he is very nice and everything is working well, but he's not doing that much. And if he would be more aggressive or so on, then he would probably push for better results at the bottom line. But maybe, I mean, he's building a company for the long run, but those kind of situations are really hard, I think. So we talked a lot about the good parts of the book and a lot of praise, but are there some content and parts of the book that you don't agree with?
Don't agree with might be somewhat too harsh of a statement, but I think the last chapter on taxation and what's the other part of that chapter? It hasn't made that much of an impression on me. The accounting policy and tax matters, right?
It's pretty country specific, I guess. Also.
Yes, exactly. And I think the only part there where is sort of back to what we discussed about perfection and so forth. That's when he talks about stock options, among other things. But it's very detailed, and it's like you said, U.S. specific, and it goes into examples that are today outdated. They're not timeless, and that might be the only drawback from having the legal angle, how the book was started and produced and thought about. Obviously, it was law professors that had a seminar and had a symposium and then went into how Cunningham organized the book. So I would say to if you've gotten tired, then the last chapter might be the one to skip.
Right. And one part that I thought about is how Buffett is critical to IPOs. And the argument is that the sellers always know more and they put their limping horse on the market a day when it walks. But we also know that it's IPO discounts that are made because of stocks. They want stocks to have good intros on the market. And so, how are your thoughts on that?
Well, I guess all or almost all stocks on the market was once IPO'd, and it's I wouldn't say, at that particular time that the seller always knows more than the buyer, and you can slice and dice those things for hours and days and weeks if it's good or not to take part of IPOs, right? And you get to different results. But it's more got to do with, it's like when an insider sell a company. Obviously, they think they know more than the buyer because that's when they sell. But there is no clear cut evidence that the insiders do better trades than other people in terms of selling. So it's just looking at the situation in itself. Is the offered price something that I think is within the a reasonable valuation range, and do we like the business? Then an IPO or a day one of an IPO could be as interesting as any other company on the exchange.
Yeah, it's always good to be skeptical, but do your own opinion and do your own work and have independent thoughts.
Yeah, and I was also thinking when I read the book, I read the letters as well, and I read a lot about Buffett in before, and sometimes I think his lessons are a bit misquoted. For example, when he says that mergers and acquisitions don't create value, but he says it does in some cases. It's just not on average. And I feel I saw the same. I mean, you see the same lessons in other sections as well. Um, I think in IPOs as well. I mean, he just says that it doesn't create value on average or so on. One thing we can see is that in 2021 we have seen records in IPOs, and yeah, Howard Marks, for example, used to discuss taking the temperature on the market, and Buffett mentions in his letter in 2000 that there was a survey in December 99 where retail investors expected 19% annual returns in the future. And we have seen similar surveys today with returns ranging between 14.5 and 17.5%. What are your thoughts on that?
Well, and then you compare that with I think it's GMO, right? That do these implied return analysis, which they've done for a number of years, and obviously the last 5 or 6 years they've seen out of whack with what's actually happening in the returns that are actually put forth in the market. But I think the latest one they produce is that the only asset class with a implied positive return, given historical correlations, so forth, is emerging market equities, right? And all others are below zero. So that's a poor picture for the average investor. But I think the reality is perhaps, as always, is some place in the middle. I would say over time. I mean, obviously, an individual company or a stock market or the listed world overall cannot overproduce profits and cash flow just because capitalism or interest rates and so forth are powerful drivers, and there's capital all over, right? They just cannot. The world cannot tomorrow produce 20% return on equity just because that's where the market is, right? So at some point, people will realize that we have borrowed our returns for the next 10 years, or our kids' returns, or whatever it might be, because the weighing machine of companies producing profits, it's what it is, right? So the 10-12% that everybody has gotten used to in the historical measurements, I guess, won't be there at some point. And the longer the markets go up, the lower it'll be. And I think at this point in time, it's hard to argue for more than 5-6% on average for the next decade or so. Obviously, people made positive returns outside of the TMT stocks in the mid 2000s, right, or the early 2000s. So there are always pockets in the market where you can make a return. But I think if you invest in an index fund, it's hard to argue for more than 4 or 5% from here.
Yeah, and that's something that's interesting because in the book, Buffett is pretty skeptic to active management of funds, and he is making the 10-year bet of holding S&P 500 instead. What are your thoughts on that?
Yeah, it's some people have gotten quite emotional about that, and I think he's betraying the active management part of the classroom. I would just say from the perspective where he is today. Obviously, he didn't say this in interviews in the 70s or 80s or 90s. If anybody outside of Omaha interviewed him in the before the 90s, but then he argued for, like he did in that article, the one security I like the most, which was Geico. Obviously, at that time he argued differently. I think it's from the position he's in now. It's you just have to take that statement. Buffett in the 2000s is different from Buffett in the 70s or 80s. It's like with this book. Another point that perhaps I'd like to make. It's people have, I guess, grown tired of Buffett and Munger. A lot of people have grown tired of Buffett and Munger, and I see that among my friends and so forth. But it's just this is Pelé in the 60s, not the one that played in the New York Cosmos in 1977. And it's Magic Johnson in the Lakers in the 80s, not the one that played in Borås in Sweden in 1990. So two different time areas, two different persons. And this book obviously portrays the original Warren Buffett.
Beautiful. Thank you so much, Henrik Andersson, for coming on the Investing by the Books podcast and talk about the Essays of Warren Buffett, lessons for corporate America, or lessons for managers and investors, as it also has a subtitle. Do you have any other book or podcast guest recommendations for us?
I would say that a good starting point for a book is the top 20 list at Investing by the Books. So I couldn't imagine a better source of inspiration or a better learning place actually to start with.
Great. And where can our audience follow you?
We have a website. I wouldn't say my employer is a company that talks about itself a lot. So, but the website, and then obviously I try to contribute to Investing by the Books from time to time, or as much as I can. So that website is also a good starting point. And we do write monthly reports and some little or longer papers about investment topics and so forth. And that could be found at the website of Didner Gerge.
Great. Thank you so much, Henrik.
Thank you. It was great to be here.
Thank you for listening to Investing by the Books, a podcast by Redeye. You can follow us on Twitter at IB_Redeye and email us at ib.podcast@redeye.se. To improve the podcast, we really appreciate your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. For the editing of this podcast, we thank Jon Hintze, and for the graphic design, Jesper Viking. I'm your host, Eddie Palmgren, and until next time, I sincerely wish you the best of luck on your journey through life and investing.